We are going to talk legacy media. Stocks remain under pressure. Viacom, CBS, and Discovery both fell in trading yesterday, though not nearly as much as the prior week, amid forced liquidation of those positions linked to Archegos Capital. Joining us now is Michael Nathanson, founding partner at Nathanson. I talked about you earlier. I don't know if your ears were burning, Michael, but reading some of your pieces before everything hit the air conditioner, the excrement, last week, you were feeling pretty good. You were feeling pretty good, weren't you? Well, we never recommended Discovery before, but we did a pretty good call there. And Viacom,
that worked out, yeah.
But
and
you're like, wow, we are great. We are great. Look at the returns we've just delivered with our recommendations on Discovery and Viacom. Did you have any idea what was going on behind the scenes at that point, Michael, or were you trying to do it on fundamental?
No, so we have 400 clients, the biggest institutions in the world, and not one of our clients was calling us up and saying, I'm buying these stocks here, right? It was the weirdest move we've ever seen, right? There wasn't, on the sell side, when there's institutional support for a name, both these names were at some point just on their own, right? It was the weirdest thing we've ever seen in our careers, basically. They were working without any real support from our client base.
Did the offering that you saw, you probably thought it was a good idea. In hindsight, do you think that? What do you think people? What do you think? No, you didn't think it was a good idea.
No, Joe. We put a sell on Viacom when a day later, right? We rushed. You saw the note. We rushed it out. It was a very large note. We couldn't get it timed. I thought they were popping their own bubble, and so we put a sell on Viacom, the Thursday of last week. Because, yes, it was a good idea for them to raise money, but it pretty much announced to the world that the valuation they had was unsustainable and ridiculous, right? So, great for them, they raised money. Bad for them, they wiped out a firm and pretty much identified a bubble in their stock, which will probably never happen again, right?
Hey, Michael, what do you think of this? Morgan Stanley underwrote that $3 billion offering, and yet they also were working with Bill Wang at the same time and worried about his own account. Therefore, they should have had close to perfect information on this. Conflict or not?
It was a conflict, bad banking. It was a bad decision, obviously, right? We couldn't identify, and that's why that size of that offering at that price was so aggressive, right? Like there wasn't support for that offering. Someone should have said, look, guys, just want to let you know, the past month of trading has been one firm that's levered 5 times, right? That would have been helpful for the company to make that decision. I think if you talked to Discovery, they would have said, we have no interest in doing that. We talked to them that day, that week. They were not interested in doing it. And I think you're right. It's a great question. Like, why didn't Morgan Stanley put the brakes on this idea for Viacom, right, knowing what they know about the demand side of that offering?
So you went back, you go back to a buy on Viacom after the fall? No, still not.
No, we're selling Viacom. We're buying Discovery. I mean, the big picture you guys ask me about all the time is that this is a tough transition for these companies, right? Like you have a great business model in the traditional cable bundle, and now you're going into a different model that's very capital intensive, that's loss making. It's just a tough transition. We thought Discovery had an easier time, so we have a buy in Discovery. But Viacom's valuation never made sense. And Joe, like we wrote in that note, we never thought Discovery would double within 90 days, right? That's not normal.
Yeah.
Right. Yeah. We're honest about that.
Shepard Smith here. Thanks for watching CNBC on YouTube.